debt is one of the most important aspects when you are going into acquiring an asset, looking at your underwriting and making sure a deal is right for you. So from kind of like a 30,000 foot view, you have a couple different options in terms of debt. Um, you have long-term hold debt, which is typically your agency loans that are fixed interest rates for a 10 or 12-year period. Those are great for assets that are stabilized, cash flowing well, and you just plan to hold them for an extended period of time. Um, other other option to just the traditional fixed agency is a floating rate agency, which is still again intended for a well stabilized deal, cash flowing, and the floating rate gives you the flexibility to sell potentially earlier than a longer term 10-year hold period. And then your kind of third option, there's really kind of three buckets of debt. It's your agency fixed, your agency floating, and then private debt, which can encompass life insurance companies, banks, life companies, private banks, balance sheet lenders, and any other sort of private financing. Bridge loans would be bucketed into this category. These types of private options are great to kind of customize your needs with your project. So some of the life insurance companies can get very good on interest rate pricing and fixed debt for a longer period of time, but also have the flexibility to work with you selling early, as opposed to agencies which have very specific prepay penalties and such. So there's really a wide variety of debt that you can look at for your specific deal. And so that kind of brings us to our first topic of working with a debt broker or not working with a debt broker. And my typical recommendation is to work with a debt broker, to find you the best pricing and the most advantageous terms. If you go direct to a bank, you may get one set of terms, and it can be very challenging to negotiate with them if there's not competition in the marketplace. And so having a broker on your side that you hire, that you work with, they can kind of get competitive bids and quotes to make sure that you're ultimately going to get the best deal. And really, the broker is kind of the middleman in the operation to make sure that the lenders you're getting quotes from are giving fair quotes compared to market rates, and also, working to kind of beat them up a little bit on pricing or terms to make sure, again, that you're getting the best deal. So my recommendation would be to, always have a great broker that you can work with on your acquisitions, because, again, the small fee that you're going to pay to a debt broker can really pay off over the long run by being able to get a lower interest rate from a lender or better terms from a lender. And so you definitely want to have that competition. Just like we compete to win deals, right? It's the same mentality. So you're going to want to have a broker to help you out and really go out to the market to get the best options available. Um, in terms of thinking about, pricing as well as lenders, there's also an important distinction between the dollar amount of debt. So if you're getting a loan for less than $1 million in debt, you're really going to be the best lenders in that small loan space are going to be regional community banks or credit unions. Again, there's some brokers who specialize in these smaller size deals, and they they are able to go out to a bunch of these relationship banks that you can work with and get some really good quotes for you on those smaller, less than $1 million in debt. And the higher than $1 million in debt, again, this is where the space gets a lot more competitive because there's a lot more business in that space. And even as you ratchet up the debt to probably greater than $10 million in debt, you can start to get a lot more competitive business. So if you think about it from a lender perspective, and even as we buy multifamily assets, right, to buy a $1 million property or to buy a $50 million property, you're really doing the same work, the same due diligence. And so from a lender perspective, if they can place more debt into a deal, they can get a little bit more competitive in their pricing and terms. So it's a win-win. So if you're the person who's been saying, like, well, my deals aren't penciling out because I can't get 3% interest rates, your deal size may be a little bit small if you are in that, $1 to $5 million in debt, and you're only working with local community banks where their interest rates may be like 3.5% to 4%. And they're a little bit different. And so, that's something that you have to keep in mind is, of course, the debt size. As it's smaller, it's a little bit harder to get competitive terms because you have less lenders in that space. As you ratchet up to, that greater than 10 million, it starts to get a lot more competitive. And again, working with a broker is going to ensure that you can get multiple bids and quotes to ultimately get the best rate. I'm going to pause and just take a minute to read some of these questions that have come in. How does a broker get compensated? So a broker would typically earn a fee at closing. So in the multifamily space, typically you have a lender that charges some sort of origination fee. Most commonly, it's 1 point or 1%. So if the lender is giving a $1 million loan, 1% of $1 million is $10,000. And so you would have a $10,000 origination fee paid to the lender, and a broker may get somewhere between a 0.5 point to 1 point as well, depending on the deal size. So again, if it's a $1 million loan, your broker may also get 1 point for their work. And again, the percentage that you're going to pay a broker can easily be made up across the deal by shopping your lender terms and making sure that you can get the best quote and terms for your deal. One of the questions in here, we're not presenting any slides, just sharing the topics from our webinar information. So you should be able to see my screen there. Next question, do all apartment syndicators use non-recourse debt? So let me get 1 second here. Okay, so non-recourse debt, it's one of the terms that is negotiable. If you are, again, on that smaller loan size spectrum, you may have recourse debt because that's what community banks always do, and that's what they're comfortable with. Typically, if you're getting a loan greater than $10 million, you'll probably have non-recourse debt, which means if there was a default, they don't come after you personally, but they will take over the asset. And of course, there's some other guarantor carve outs if there was fraud or illegal operations at the property that led to the poor performance. So with non-recourse loans, this a follow-up question in here. Are the general and limited partners both non-recourse or just the limited partner? So with a non-recourse loan, every person involved, whether it's the GP or a limited partner, has non-recourse against them. There are specific individuals called out as guarantors, and they will have a few items where the loan could be recourse against them. So I would encourage you to read the terms of the loan agreement very specifically and understand that if you are the general partner. If you're a limited partner and you just invest passively in a deal, there is no recourse against you personally. If anybody needs help, okay. Webinar page in the browser. Yep, I'm sharing the webinar page, and here's kind of the general topics. Do the lenders still review sponsor financials? Yes. So the sponsor for the loan or the guarantor does have to meet lender requirements, typically a net worth equal to the loan amount and a 10% cash liquidity. And so if your loan is $10 million, the guarantor or the sponsor would need to have a net worth equal to $10 million. And they would also need to have typically $1 million in cash or cash equivalents to be liquid from a liquidity qualification standpoint. And so that could be, you have $100,000 in checking account plus $900,000 in a stock portfolio account. The lender would need to see statements of that, and then they would be able to approve you for the loan. Let's see here. Good questions. How do I find a debt broker? I would encourage you to ask some of the brokers who are selling real estate deals. Typically, that's who they work with. A couple of good lenders out there. You have Newmark, Knight and Frank and KF. You have Walker and Dunlop. You have Arbor. You have Berkadia. You have CBRE. So a lot of the same real estate names also have brokers. But again, depending on your situation, if you need someone more local, that may be where you want to ask a broker who is selling real estate in the deal size that you're at. So again, if it's a smaller deal, less than 5 million, I would check with the broker who's transacting the real estate sales to see who they might recommend so you can get a good fit for the deal size. If you are greater than 10 million bucks, the names that I rattled off previously would be some good folks to reach out to. And again, I would, if you have not worked with a broker before, I would have, 3 to 4 conversations, not commit yourself to working with anybody, but just see what they can do, check their references. And eventually you'll find a couple that you like to work with, and you can kind of build that relationship and have a long-term one with them. So we've got that done. Let me check the chat box one more time. Just to clarify, the liquidity requirements are for the sponsorship group. So yes, the sponsors for the deal, if you're syndicating a deal, could be different than the sponsors for the loan. And so with the loan sponsor and loan guarantor, those two words mean the same thing. You could have multiple guarantors who have a combined net worth and a combined liquidity to get you to qualify, or it could just be one individual if they have a large net worth and a large liquidity for that one single person. Let's see here. A couple more questions. I only have 2 multifamily homes. Each one has 3 units. I'm trying to refi these. The total loans that I'm trying to refi would be, no, 800 to 900,000. I think you could definitely work with a broker. You're going to need someone who is more local to you and who is familiar working in that smaller deal size range. And so, you know, I would probably do a Google search for your area and find a broker that way. I would also talk to some real estate sales brokers for multifamily properties in your area to see what you could have. The other piece is, you could do your own kind of quotes and brokering by reaching out to a few local community banks. Deborah, in your situation, for like a $800,000 to $900,000 loan, you might be able to just do a local portfolio loan with a commercial lender. So I would go out and try to make contact with 4 or 5 different people in the debt space and see what's the best direction for you to go in. But you absolutely could work with a broker. Liquidity for agency loans doesn't have to be $1 million. So very good. That is not, we'll move on to the next question. Does Dscr requirements change with loan size with personal experience? So from an agency perspective, if you're going to work with Freddie or Fannie, no, the Dscr is typically going to be that 1.25 requirement. If you are getting a private loan, either from a life company, from a balance sheet lender, from a bridge group, you could have a lower Dscr requirement depending on the deal size. Okay, the local banks and credit unions only have loans with interest and principal payments. So Ray, to answer your question, that's where if you have multiple quotes from folks, you could get maybe a year or two. You could get maybe a year or two of interest only, but it's not going to be the same terms that you may hear people in the large multifamily space where you could get an agency deal with IO for the entire 10-year period. Again, local banks and credit unions have different requirements, but you might be able to get a year or two of IO. You just need to really work with them, and that's where a broker could potentially help you out tremendously. Okay, coming into a couple of the final thoughts here. I just want to make sure we cover the topics, and these are some great questions in here. So we went through really the broker, no broker. I talked about the various types of debt options. Again, if you don't feel like you're knowledgeable in this space, that's where working with a broker is going to really help you learn a lot to make sure that you're getting the best deal. Prepay penalties and or yield or spread maintenance are very important to understand when considering which loan to go with. And so, the difference between an agency loan and a private loan, or even a fixed or floating rate loan, is that prepay. And so there's some people today who bought properties in 2019 that have significant prepay penalties, and it may be very hard to sell their asset because the prepay penalty is so significant. And so that's where truly understanding that. And again, if you don't know how those prepays work inside and out, that's a great question to ask your broker. When they bring you a term sheet with multiple lender quotes on it, you need to be able to understand, okay, do I have to hold this for the entire duration, or what's the prepay for me to get out of the loan? From a supplemental loan perspective, so this is typically done most commonly with an agency loan, either Freddie or Fannie, where you are able to do some sort of value add at the property, basically increasing the NOI, which in turn increases the leverage ability to continue to meet the Dscr requirements for the lender, and therefore the lender would be able to go and give you additional debt because your property is generating more income. The property can support a higher debt amount and still maintain the Dscr requirements. So typically with a supplemental loan, you can only do one every 12 months. There are some closing costs and fees associated with it when you do it. But again, I wouldn't plan on syndicating a deal and expecting to get a supplemental loan. It's just one of those like nice to do if it works out. But I would not plan to build that into my underwriting in order to make a deal work. So let me see the last couple of questions in here. Does the guarantor typically get a fee at closing? Yes, they typically do in a syndicated deal because there is risk for them and also a purpose for what they're doing and working with the lender to guarantee that loan and also qualify for the loan from a liquidity and net worth perspective. So that being said, I think I've covered all the questions. If there are any more, put them in the Q&A box and chat box. Tatiana, thank you. I hope everyone could hear me clearly throughout as I am doing my dad duties in addition to talking about debt. So, we love multifamily and syndication in our house. And it's just one of those things that we roll with and we do. So that being said, it's really, really important to get the right debt for your property. There's very specific terms that can really make or break a deal. And there's really good lenders and sometimes there's not so good lenders. And again, that's the experience of working with a broker who's been in the space for a while. You want to avoid working with lenders who are just not nice people. And so, I would encourage you, if you have not done a deal before and a lot of the terms that I may have thrown out today, if they did not make sense, have a conversation with a debt broker about your next acquisition so you can learn more and also make sure you're getting the most advantageous debt for your property. That being said, I am signing off. The link for the next MFIN webinar is available, so sign up for it. Melissa is so amazing on our team. She's already got the website corrected. So next week, we are going through key metrics to look for in a submarket for an apartment syndication. So this will be very helpful for you to find markets to invest in. And now we've got the tools to get the best debt for your property. So thank you, everyone, for joining us. And I appreciate all of the wonderful comments of fatherhood. And I am just grateful that you could all join me and take part and still learn something about debt. So have a great day. If there are follow-up questions, please reach out to our team. Happy to point you in the right direction or share any references that can be valuable to all of you. So have a great afternoon, and we'll see you next week for key metrics for markets.